People are more aware of financial fraud than ever before. From crypto influencers to suspicious-looking text messages, we are all trained to be on the high alert about everything. Unfortunately, the fact that we now suspect everything is a scam is a big reason why financial fraud is at an all-time high.
I lost the majority of my life savings in a dating scam.
Well, you're tightening the belt this year and saving money, but there are a handful of growing scams that are designed to steal your money.
Dating scams where fraudsters convince people to put their money into fake cryptocurrency investments.
But in 2023, the scams are a lot more sophisticated than you may have realized.
Society loves con artists. Don't believe me? Think about this. We are all celebrating Sam Bankman-Fried being convicted of defrauding millions of investors out of billions of dollars. For now. But the same crypto enthusiasts that lost money when FTX collapsed probably at one point or another celebrated the wealth in excess of the Wolf of Wall Street, another convicted fraudster who stole millions of dollars from investors. The future is clear. In 40 years, the insufferable hustle bros will be liking inspirational quotes pasted over the top of SBF. Okay, that might be funny to think about, but it happens all the time. The reporter Aaron Griffith with the New York Times wrote about the hundreds of fake companies with fake business plans and fake users being created to attract venture capital investment. Firms like Sequoia, Andreessen Horowitz, and Excel had so much money that they couldn't invest into new ideas fast enough. This started to encourage hopeful founders to fudge their numbers a bit to get a life-changing investment. There were companies that used that money and did build out a real business, but there were other companies that had to keep on lying as more and more investors piled in. If you were a company founder trying to be completely honest about your business, you would have found it much harder to get an audience with these investors to pitch your idea because you were competing with other founders who weren't afraid to stretch the truth or flat out lie to tell investors what they wanted to hear. The venture capital firms that lived by the Silicon Valley mantra of growth at all costs didn't even care because even if the companies they were invested in never made a profit, they could hype them up enough to sell them to strategic investors or dump their trash on the general public through a SPAC. Cases like Charlie Javis, who faked millions of users on her app Frank before selling it to JP Morgan for $175 million, or Abraham Shafi's IRL, another app that had millions of daily users that raised $150 million at a $1 billion valuation, before an investigation by the board found that 95% of its users were also completely fake. From just these two fake apps, that is a total of $325 million that could have been invested in real startups. But there are 5 reasons why fraud beats honesty almost every time. The first reason that fraud has done so well, even though people are more aware of it than ever, is because nobody bothers checking anymore. While good, honest companies and people are held down with honesty and regulations, scammers and fraudsters can just lie about how great their business is. The reason that they can get away with this for so long today is because fewer people are checking. According to the remarks of their own administrators, organizations like the Securities and Exchange Commission, Federal Deposit Insurance Corporation, and the Federal Trade Commission don't have enough resources to regulate market activity. According to the SEC enforcement results from 2022, the agency is now relying mostly on whistleblowers to prosecute pump-and-dump schemes, securities manipulation, and insider trading. Now, you all know about government regulators being underfunded, but the private sector also failed as well. FTX, Theranos, and WeWork all raised billions of dollars from sophisticated investors that did very little due diligence to verify the lofty claims of the founders. Low interest rates, a hype around venture capital investing, and the growing popularity of SPACs meant that there was a lot of investor money looking for the next big thing. Eccentric founders had the luxury of shopping around for investors who were all desperate to get their money into whatever company was generating the most buzz. And the companies that could generate the most buzz were the ones that could just lie about doing something that could change the world, if only it were true. From my personal experience working as an investment banker in the healthcare space, less exciting companies that are honest about their realistic objectives are drowned in due diligence by more experienced private equity professionals, while companies making wild claims about changing the landscape of the medical world are waved through by venture capitalists that think they are much smarter than they really are. Now, big companies are getting ripped off by founders with questionable attire, but that's not where most of the fraud is happening. Most fraud is targeted at regular people. And even if they don't make any dumb mistakes themselves, offloading the cost of scams onto people has become more lucrative than ever thanks to 2 other concerning trends. So it's time to learn how money works to find out why the world thinks everything is a scam, except for scams. Big companies with sophisticated investors knew the risks of doing no due diligence, and investing hype is finally shifting away from firms promising to be the Uber of in-office kombucha taps. But people suspecting everything of being a scam, apart from scams, the paradox of the grift if you will, does a lot more harm to normal people who don't have the time or resources to thoroughly vet every offer they are given. The people being hurt the most by these smaller scale frauds are not who you would expect. The most common victim of financial fraud is not elderly people with deteriorating mental capacity getting targeted by scam callers claiming to be the IRS. According to data by the FTC, these scams do fool millions of people every year, and more should be done about that to educate and protect people at risk. It sucks that every single email, text message, and phone call needs to be analyzed for sketchy links, and it can be exhausting. But at least it's possible with a bit of attention to stay on the right side of these scams. But the fastest growing category of financial fraud is much harder to protect yourself against. And to show you why, we need to talk about influencers. Seeking fame and fortune is nothing new. And people running get-rich-quick schemes on late-night cable are nothing new either. But technological and cultural changes have allowed these people to merge into one. I don't want to reveal my age here too much, but back in my day, celebrities were afraid of being labeled as sellouts. They had to be very tactful about promoting their merch or their fans would turn on them. Today, selling out is the goal. Modern celebrities and influencers are celebrated for launching a new product line and go on interviews where they talk extensively about how much money they make. There is nothing wrong with celebrities making money, and some influencer businesses sell great products, but a lot don't, and a lot get much worse. According to a 2021 survey conducted by the FTC on consumer losses through scams, 61% of all fraud contacts initiated on social media and websites. Email, online ads, phone calls, and text messages were all fighting for whatever was left. The people you watch and trust online are by far the most likely to scam you. Influencers know that their influence won't last forever. Tastes change, their audience will outgrow their content, or they could be caught up in controversies that gets them kicked out of their respective platform. That's show business. But the problem for the new age of celebrity is that the antics that they self-publish onto the internet would make it impossible for a lot of them to get a real job afterwards. So they need to make enough money in their few years of fame to fund their lavish lifestyle forever. It's not impossible to do legitimately, but it's much easier to do by jumping on the latest trends. If you are an influencer and you know your audience is eventually going to get bored of you anyway, it's very tempting to make as much money as possible off them on the way out. And that's the second reason why people think everything is a scam, apart from scams. Fraud is exciting. Reality is depressing. Imagine you had $10,000 to spare, and you are deciding where to put it. A BlackRock broad market exchange traded fund, or a crypto token from a YouTuber. I really hope you all watching know what the right choice is. On a different corner of the internet, you will see people hyping up very risky plays to an impressionable audience while making laser-eye video thumbnails about how BlackRock secretly rules the world. One of the biggest business and finance influencers in the world, Patrick Bet-David, has made countless videos talking about the dangers of Vanguard, BlackRock, and State Street while defending multi-level and network marketing, including his own multi-level marketing life insurance company. BlackRock is not a faultless business, but your money will be safer with them than it will be with the average influencer. My friend Richard over on The Plain Bagel made a great video about why investing won't make you rich. It can only build wealth by accelerating diligent savings. But that's boring, and that kind of content doesn't make as much money or perform as well with the algorithm as flashy displays of material wealth and non-compliant claims about making money. Even influencers not peddling get-rich-quick schemes need to over-sensationalize everything to maximize engagement. I know I pick on Graham a lot, but judging by his thumbnails, this guy has been bankrupt 4 times this year alone. Influencers are an easy target for ridicule, and I understand as a now full-time YouTuber myself, it's tempting to use the flames and laser eyes. But it all builds a culture of getting as much attention as possible, as quickly as possible, and then trading that influence for cash. The biggest problem is that there appears to be very few consequences for doing this. People like Logan Paul, who at the height of the cryptocurrency mania promoted several pump and dump schemes, has to date had no problems with regulators who are struggling to keep up in this area as well. He also hasn't even taken that much reputational damage and still has millions of fans watching his videos and buying Prime energy drinks. Another friend of the channel, Patrick Boyle, in an interview with Zeke Fox, an investigative reporter for Bloomberg, and author of Number Go Up, said that the grift is not something to be embarrassed about anymore. It's now seen as high status, because the most visibly high status people are all doing it. Fox also claimed that investigations into this matter almost don't make sense anymore, because the perpetrators of this kind of fraud are so unashamed and open about it that an investigative journalist doing an expose on Dink Doink would be like a food critic writing a review on Taco Bell. And that's the third reason why we think everything is a scam apart from scams. Fraud moves faster than we do. New technologies like cryptocurrencies, AI, and the internet all may have legitimate marketable uses, but it can take years for people to figure out what those use cases are and years more to build businesses around them. It's little wonder then that the new technologies are a golden opportunity for fraud. By promising to know the secrets to using something new to make lots of money, grifters can leverage the natural hype of barely understood tech to sell a guide on how to use it for a profit. The hustle bros that were selling crypto trading guides when Bitcoin was entering the mainstream are now telling you how to use ChatGPT to make millions by automating some vaguely legitimate sounding online business. This problem hits every level of finance, not just core scammers. The venture capital funds that were throwing investor money at blockchain companies are now throwing investor money at anything that claims to use AI. And the influencers that were crypto experts now know how to use ChatGPT to make $300 a day. The rapid pace of new technologies that people are desperate to understand is behind the rapid pace of new frauds pretending to know the answers. The reason that people are so desperate for the answers is also the fourth reason that they are so willing to convince themselves that a scam is not a scam. People are desperate. I don't need to say too much about this one. According to Lending Club data, 62% of Americans are living paycheck to paycheck. Nobody earning minimum wage can afford to rent a basic 2-bedroom apartment anywhere in the country. People have to jump through up to 17 interviews to get a job. Interest rates are rising, basic essentials are twice what they cost 5 years ago, and most people don't think there is any hope of changing that.
The housing crisis in the United States is real. It is incredibly difficult for people to buy a home.
Sad as 4 in 10 consumers consider themselves worse off than last year.
Anything promising a way out of a no-hope situation looks good to a lot of people. The fifth reason why we now think everything is a scam, apart from scams, is because the outlets that were supposed to be keeping us informed about this have also decided that there is more money in sensationalism. A good grift requires people to believe 4 things. People need to believe it's credible, people need to believe it will give them wealth or a better life, people need to believe it will be easy, and people need to believe that the grifter has a secret to making it all work. AI is going to be a better opportunity for scammers than cryptocurrency, and it's already starting.
But I'm going to be going through exactly how you can use this new AI bot called ChatGPT to help you when it comes to making money online.
In this video, I'm going to show you a stupid, easy way to make money with ChatGPT.
I don't need to tell you about ChatGPT. If you have been anywhere on the internet in the last 6 months, you already know about what it and other programs like it can do. Designing images, writing code, and creating content are the most time-consuming tasks in the most typed-up industries, tech and online marketing. If you pay attention to this space, you will hear about people making enormous fortunes on a daily basis. The challenge is that coding, writing, and creating digital media takes a lot of effort and requires talent and experience. Someone who needs quick money now doesn't have time to learn about web development or take a Photoshop course, and AI is the answer to that. New programs can take basic prompts and create viable content which can then be monetized. Except it just doesn't work, and idiots on the internet need to stop telling you it does. New AI programs are not going to make you rich, and there are 4 reasons why that happens to line up perfectly with the ingredients that make a great grift. The first reason is that the fields they apparently work in only reward top performers, and AI doesn't produce content as good as the best humans. The most frequently recommended AI hustle is creating fully automated YouTube channels. The business plan is to get ChatGPT to write you a video, Midjourney to create a slideshow of visuals, and some freemium online software to turn it into a video to post on YouTube and make that sweet ad revenue. To qualify for monetization on YouTube, a channel needs a minimum of 4,000 hours of watch time and 1,000 subscribers. That doesn't sound like much, but less than 1% of channels ever qualify for the partner program, and this barrier was so challenging for new channels to overcome that YouTube lowered the requirement to 3,000 hours of watch time and 500 subscribers. Even of the channels that gain enough of a following to be monetized, most are only making a few dollars a day. It took me, and most of the other creators I speak with personally, more than a year of making content before we were monetized. Making videos is time consuming, so letting AI do all of the work for you plays well into one of the key ingredients of a good grift. People need to believe it will be easy. The trouble is that AI is just not very good yet, and the reason you don't see many other channels run by robots is not because people aren't trying. It's because the YouTube algorithm simply isn't making them as visible, because there are better videos made by real creators still putting in effort. You may not like the weird energy of Mr. Beast or the Paul brothers, but they are much more engaging than an internet word generator, so they get millions of views, and the millions of people trying to create automated channels get nothing. Dropshipping is another common grift that has the same apparent advantage, which is really its biggest weakness. If you are one of the lucky few that has not had the dropshipping dream pitched to you yet, the business plan is to find overseas companies selling cheap products overseas using websites like Alibaba. Once you find something you think will sell well, you set up a website of your own to sell those products at a higher price. When someone buys something off your website, you turn around and buy it off the overseas seller and simply give them the address of the purchaser so they can handle the postage and you keep the profit. But not only will you be competing with the thousands of other people that are trying to do the same thing, you will also be competing with Walmart and Amazon that offer faster delivery times, better brand recognition, lower prices, a wider product selection, and have millions of visitors visiting their stores all the time. People selling dropshipping courses also rarely admit that your customer could also just go on Alibaba themselves and buy the product at the lower price. Creating content using AI runs into all of the same problems. It's pitched as an easy way to build a business or generate side income, but it's never going to compete with the people putting in real effort to bring a better product to market. How long would you watch a video of an AI voice reading a procedurally generated script? Wouldn't you rather spend your time on YouTube watching content from dedicated creators? Of course you would. And since YouTube wants you to use their platform for as long as possible, they will only promote content that keeps people engaged. But what about all the people who did get rich off of dropshipping and the people already making money using AI? Well, the lack of competitiveness that a zero barrier to entry business has is just the first problem with thinking AI will magically make you $300 a day. The second reason that AI has already become such a great grift is that the ways that it can make you money sound credible. ChatGPT only mixes together stuff it scraped off the internet, but it can still do some pretty impressive stuff.
And we're gonna get some answers. Is it magic? Is it just algorithms? Is it gonna save us or destroy us? Let's go find out.
Another popular plan to make money using AI has been letting ChatGPT pick stocks for you. All the big financial influencers have made some variation of this video, and even reputable outlets like CNN Business have written articles suggesting that AI chatbots can pick stocks for you better than a fund manager. I hope to most of you that sounds totally ridiculous, because it is. But it's also easy to understand why people would fall for this. Financial education is severely lacking in America and most other countries. People are told that they should invest, and it's normally left at that. Accessing a paid financial professional is expensive and makes the mere act of investing pointless if you have to pay someone $2,000 to tell you how to invest your remaining $8,000. So the only option is turning to people on the internet that give general advice that won't be suitable for everyone, or in some cases, anyone.
Choose from. That's why I'm really proud to stand behind today's sponsor, FTX.
Another thing that people know is important but don't know much about is AI. Speaking with just a little bit of authority about these two topics will attract a big audience. There are computer programs employed by major quant funds that are coded by people with PhDs in statistics, physics, and computer science. These are programs that use millions of data points to gain a slight edge in trading. This makes the claim about AI investing sound credible since ChatGPT is an impressive computer program that uses a huge dataset. It's been able to do things like pass the bar exam on its first try, so it should be able to do the same thing as those quant algorithms, right? Wrong. The programs that quant funds use only work when they exclusively execute a strategy, and they often don't work. And when they do, they only work for a short time before the market reverse engineers what they are doing and does the same thing. That's very different from passing the bar, which is mostly a test of memorizing legal precedents. Since ChatGPT has a large bank of training data, it gives it an unfair advantage. An average person with some basic legal training could probably pass the bar too if they were allowed to bring a laptop with an archive of case law into the exam room, but they are not. Investing is very different from passing the bar. Any strategy that can be accessed by typing a prompt into ChatGPT is going to have zero competitive edge over the market, because anybody else can do the same thing. Also, ChatGPT does not take your personal financial situation into account, and since its training data only goes up to 2021, it's out of date too. The reason that better financial creators on YouTube don't talk about what to invest in is because they know it's impossible to give good advice to such a large audience. This is frustrating for them, because they can see how much money other people are making by claiming to be financial experts and giving advice that is really hurting people.
So don't ever expect Meet Kevin to sell you a stock investing course. Thank you so much for considering this course.
You are fake news.
It's also frustrating to their audience because people like Patrick Boyle, The Plain Bagel, and Ben Felix are financial professionals with qualifications, licenses, and certifications that make them much better equipped to give advice. But it's because of their experience that they know that they can't give advice. A simple recommendation like, you should buy a broad market index fund is good advice for some people, but it can be terrible advice for people with short-term financial goals, high interest debt, or no emergency savings. Since as YouTubers we can't control who watches our videos, the next best thing we can do is not give any advice at all. ChatGPT has the same limitations. It doesn't understand your finances. It just predicts what word makes the most sense to type out next. So even if it does look like it can make everything easier, please don't use it for financial advice. The AI hype is made to sound even more credible because there are people that are going to get rich off this technology. The fear of missing out on an exciting trend like this can make it hard to stay sensible. The people that are going to make millions in this industry fall into 3 categories. The first group are the people that can actually create programs like ChatGPT, because they are geniuses in the fields of machine learning, allowing them to start their own companies or negotiate huge salary packages from big tech companies that want top talent in the space. The next group are people who have already invested into AI companies that are now benefiting off investor hype. And the third group are people that run regular businesses that can use AI to make operations more efficient, which is different from building a business completely from scratch using AI. If you're not in one of these groups, that's okay. Nobody can be in the right place at the right time every time, and chasing trends is a costly exercise. The third reason that AI is going to make such a great grift is because it's easy for people to claim they have the secret to making it all work. AI programs are easy to use, but they still have a learning curve, and to utilize them to their fullest potential, you are going to need to look up guides online to learn how to get it to work and what can be done with it. That's an easy way for people to make big claims and soak up those sweet clicks. They might claim it's harmless, but it isn't. And that's because one of the biggest problems in the YouTuber finance space is a strategy I call the bait and backpedal. This is where a YouTuber will post a clickbait title like, how to use ChatGPT to become a millionaire, and then say nothing in the video about how this program is supposed to make you a millionaire. The people that have perfected this strategy will even cover themselves in the video by saying that people shouldn't risk their money, and that AI is not made for this, which is the backpedal part of the strategy. That means if they are ever called out, they can just claim that the person didn't watch their video, but by that point, the damage is done. Not every person that sees a thumbnail will click on it. I am pretty bad at clickbait, so my numbers may be worse, but for every 1 view on my channel, my video needs to be displayed to 15 people on average. A lot of people will just see that ChatGPT can make them a millionaire and never watch the video that says precisely the opposite. And that's the fourth reason. It's easy to believe that this could change your life. Starting a business or investing is not exciting. If it's exciting, you are probably doing something wrong. Investing is a long-term and boring exercise that rewards discipline more than chasing trends. Starting business is the same with the addition of a lot of hard work. Multi-level marketing companies like Herbalife, Avon, LuLaRoe, and Amway are often mischaracterized as pyramid schemes, an illegal structure whereby people pay a fee and then try to make their money back by taking a share of the fees that the new members pay to join the scheme under them. But I, in good faith, can no longer sit by and watch the good reputation of pyramid schemes be ruined by comparisons to multi-level marketing companies. MLMs are not pyramid schemes. They are worse.
There's an internal document at Herbalife where they made the case for pursuing this market. People who make $2 a day, $5 a day. And so you have a company based in the United States that decided to target this population with a business opportunity which itself is a fraud.
You have probably all heard of MLMs by now. Maybe you have been pitched the amazing business opportunity by a friend or colleague, or maybe you are part of the 8% of Americans who have been part of one of these schemes in their life.
I ended up being in Amway Ltd for 2.5 years. And in that time, I only sponsored one person. I lost about $18,000 in the process of...
The business structure of every multi-level marketing company is slightly different, and the same companies use different structures in different markets to skirt around local regulations, but the basic concept remains the same. You sign up and join the company as an independent business owner. You pay a fee which can range from $20 to $5,000, depending on the company. For that money, you get given a simple pack of the company's products. You are encouraged to sell these products at a markup like a traditional business, but you are also told to sign up friends and family under you to share a cut of their commission. Commission structures are intentionally made confusing so that new recruits can't understand how badly they are being screwed. Most of the money gets funneled to the very top of the program to people that will flash a lot of money around as proof that the system is working. If you think this sounds like a pyramid scheme, you're not alone. Even the Federal Trade Commission, after it concluded a year-long investigation into Herbalife, the third largest MLM in the world, concluded that the company was not determined to be a pyramid scheme.
For embattled company Herbalife, the Federal Trade Commission will not classify it as a pyramid scheme, but in return, Herbalife will pay a settlement of $200 million.
But really, these companies are a lot worse for 3 reasons. The first reason all comes down to what actually legally separates them from a fraudulent pyramid scheme: their products. One of the most powerful lobbying groups in America and around the world is the MLM industry. Herbalife, just one of hundreds of MLM companies, spent $810,000 on federal lobbying in 2021 alone. The legal argument is that money only changes hands when a product is sold, so they are no different from commissioned salesmen. Unfortunately, it's exactly that product that makes MLM so much worse than pyramid schemes. The average return for a victim of a pyramid scheme is a reduction in 10% of their invested capital, or 90% of what they invested. For every $1 a victim puts into the scheme, they can expect a return of 90 cents. A bad investment, but not financially crippling. The returns remain surprisingly high because early investors get paid out, and when the whole thing falls apart, the money really hadn't gone anywhere, and a portion of it can be recovered by authorities and returned to victims. Bernie Madoff ran the world's largest Ponzi scheme, and even most of his investors ended up getting most of their money back because after Madoff used the money to buy a penthouse apartment, a private jet, and a house in the Hamptons, he had nothing left to do besides keeping it in the bank and paying it out to investors.
I thought I would never see the money again.
Pyramid schemes are different to Ponzi schemes, but the results are the same. However, the average return of a multi-level marketing company is around 30% of their invested capital according to their own marketing materials promoting their bonus structure. That means that someone joining an MLM company would be 3 times more likely to make money by signing up to a fraudulent pyramid scheme. The actual returns for most people are far lower than 30%, and sometimes even the highest ranks of MLM members struggle financially, but we will get to that soon. The reason the numbers are so bad is because of the product. For the people at the very top of the MLM to collect everybody's money legally, they need to move a lot of products. But the product has overhead that siphons money out of the scheme. Some money goes to manufacture and ship the products, and some money goes to the MLM company itself. MLM products are priced well above market competitors, even after the discount given to their members, because the companies need to add the overhead to pay out bonuses. Product quality from these companies is also a common complaint amongst former members. The companies themselves use their members to promote their business. The main way that members sell the business to other would-be members is by promoting business opportunity as a way to make additional income or achieve financial freedom. Since the products are merely a side, though, to provide legal protection, there is a little pressure for the companies to make their products, good. Somehow, having returns 3 times worse than the most infamous corporate fraud in history is only reason 1. The second reason why MLMs are worse than pyramid schemes is because even the people at the very top of these companies don't make their fortunes from the business itself. The most effective marketing for these companies is the lavish lifestyle of their high-ranking members that will be splashed all over social media and shown off at the company-wide seminars. To further sell this image of financial freedom and a luxury lifestyle, the companies will award members with arbitrary ranks within the company. For Amway, It Works, Kayuani, and Usana, these ranks are named after precious gemstones: ruby, sapphire, emerald, and diamond. For Herbalife, the ranks are ironically named after executive positions in a normal company: supervisor, president, chief executive, and founder. High-ranking members will be awarded with additional bonuses and perks like free cars, expensive jewelry, and luxury vacations to exotic locations. They are obviously encouraged to show off these perks as further proof of their financial success. But even at the very top of a scheme, a lot of members struggle financially. All MLM companies operating in America are required to provide income disclosure statements that display the earnings of their members. Amway, the largest MLM company in the world, reports that the top 1% of their independent business owners make an average revenue of $87,422 and median revenue of $56,096. Those numbers are slightly above typical for an entry-level professional, but that is just revenue. In an alarming amount of cases, it's the people in the top 1% of these schemes that lose out the most financially. As part of running a multi-level marketing business, independent business owners are expected to spend a lot on the company's products for their own personal consumption. Representatives often espouse lines like becoming a product of a product. Monthly spending on these products can be hundreds of dollars. In addition to this expense, high-ranking members are expected to spend money on material displays of wealth to lure people into the lucrative business opportunity. In order to maintain their artificial rank, members of MLMs are also required to maintain a level of business volume every month. Members are conditioned to covet these arbitrary ranks by the company and other members in the scheme. Motivated by the fear of losing their rank, members will make up the difference by personally purchasing extra products that they convince themselves they can sell later at a markup.
You make a little, not much, not enough to pay the bills that are racking up. You make money from signing people up.
This creates a problem so common that it has its own name: garage qualified. where high-level members qualify for their rank because of the boxes of product piling up in their garage.
So people buy product more than they can sell. It sits in a garage. What happens? There's got to be an endpoint here at some point.
When they run out of money, there's an end.
The financial figures seen on the FTC disclosure statements are top-line revenue figures, and do not account for all additional expenses, which means even top members end up struggling financially. Back when Vice was good, they conducted a series of interviews with former top representatives from LuLaRoe, a multi-level marketing company that sold clothing and accessories. The women, who were all at one point in the top 1% of the company, were financially destitute after running up credit card debt to keep up appearances for people beneath them in the business. They, like LuLaRoe and Vice Media for that matter, are all now bankrupt. But maybe I'm not being totally fair here. There are a few people in these schemes that do make millions of dollars every year, not just in revenue, but in bottom line profit. The only problem for everybody else is that they don't make it by working the business. Roughly, the top 50 members from every company have all figured out one way to reliably make money in an MLM, and it is obviously at the expense of everyone else.
You are not selling clothes. You are giving people freedom. You are giving people life. You are giving people hope. You are giving people confidence.
I wasn't alone in receiving merchandise that I just was not able to sell to anyone because it was crap.
A business that is full of people that want to get rich quick and look up to high-ranking members as role models and mentors is the perfect opportunity to sell overpriced books, seminars, and courses. Top members in MLMs will host conferences, where aspiring members can pay hundreds or even thousands of dollars to attend weekend events to listen to live speeches by top-ranking members. In addition to these events, members will be encouraged to buy books and CDs to share with other people they try to recruit. For the people at the top, it's a win-win, only it's them that's winning twice. They generate additional revenue with much higher margins by selling tickets to these events, and the whole thing is set up to make people more invested in the business opportunity that they sit at the top of. Unfortunately for everybody else in the scheme, the seminars, books, courses, CDs, and training sessions become yet another expense that reduces their already modest income. The third reason that multi-level marketing companies are worse than pyramid schemes is because they intentionally do much more than just financial damage. New recruits in multi-level marketing companies are told to leverage their existing contact network of friends and family members to find customers to sell product to or to sign up as members themselves underneath them. Unless you have been living under a rock, you have probably already heard about multi-level marketing companies and their damaging business practices, and so has everybody else, so finding people willing to support the scheme is harder than most new recruits expect. The groups most open to multi-level marketing companies are therefore isolated cultural groups that are less aware of this industry's reputation or are inherently more trusting of their own community. The business structure of multi-level marketing companies doesn't form the shape of a pyramid. They actually form the shape of multiple pyramids, each with a charismatic leader at the top. These groups, or networks as they are called, are heavily segregated by race and religion. Companies will develop Mormon teams, Latin American teams, African American teams, and Asian American teams, as the dream of the business can be sold by using customs and pressures unique to each culture.
Opportunity for anybody, everybody. And Latinos grabbed it a little stronger. All of a sudden, all the non-Latinos are seeing these guys rise up, making money, getting recognition, and going, whoa, what are they doing?
Mormons are overrepresented in MLM companies because the culture values women staying home to raise children. This gives them few opportunities to earn an income for themselves, making the MLM pitch of making money from home more enticing. Mormons also have a strong social network of other Mormons who inherently trust one another, so these schemes do very well in this community. There are over 70 MLM companies located in Utah alone. Multi-level marketing companies are also overrepresented in migrant communities. When moving to a new country, most migrants want to find people they can socialize with and ways to make additional income. MLMs pretend to offer both. Since the whole system is built around social relationships, it can be very hard for people to leave the scheme after they figure out that they will never make money. Members are told to cut off communications with friends or family who don't join the business or buy their products, because they are a negative influence on their journey to become a successful entrepreneur. The actual reason high-ranking members encourage their new recruits to do this is because they know friends and family are the people most likely to talk them out of the business. And if they can cut them off from their normal social circles, they will become dependent on the business for something more important than even money: human connection. People heavily involved in these businesses struggle to maintain any friendships outside of their network. Combined with the social pressures from letting down members of their community, it makes leaving the business extremely difficult. Pyramid schemes do ruin people financially, but they don't ruin them as badly. and they don't ruin their relationships at the same time. Anybody who has been anywhere near the internet in the last 20 years should know by now that you don't send money to Nigerian princes with Yahoo email accounts or corporate executives playing League of Legends during an investor meeting. Fraud is the wrongful or criminal deception of a person or institution to result in the financial or personal gain. With such a broad definition and so much money to be made, there's little wonder that fraud comes in all different shapes and sizes. There are the big-ticket frauds like Theranos, FTX, and Evolvus Ramasauskas's $100 million invoice scheme that took money from the likes of Google and Facebook over a period of 2 years by cleverly gaining access to their email servers. Then there are the less high-tech approaches like the IRS agent that needs you to pay your back taxes with iTunes gift cards. The emergence of new technologies cannot be overlooked in this trend as well. Fraud is at an all-time high, not in small part because technologies like the widespread adoption of the internet, online payments, sensitive file storage, and of course cryptocurrencies, which have all made this criminal behavior even more lucrative and much harder to trace. Fraud did exist before these technologies became mainstream, but to a certain extent, it required the fraudster to be there in person, which narrowed down their target audience and increased the risk of them being apprehended for their schemes. Today, there are a wider variety of schemes, scams, and frauds than ever before, which are targeting everybody from vulnerable elderly folk to the most sophisticated financiers in the world. The $5.8 billion that Americans lost to fraud in 2021 did not include money lost to some very important categories. The NFT market at its peak was worth around $17 billion according to Bloomberg and Dune Analytics. Since that peak, it has lost over 97% of its value and is now worth less than $500 million. A lot of unsophisticated investors got into this market because they were told by so-called experts that it was going to be the next big thing, and that monkey JPEGs were their surefire ticket to financial success. A lot of those experts benefited directly from getting suckers to buy into the NFT dream. Many of them used their positions to sell these assets directly, but because they didn't technically lie about any part of what they were selling, this loss is not counted towards the figures collected by the Federal Trade Commissions. Even people that orchestrated textbook pump-and-dump schemes using NFTs or cryptocurrencies have thus far mostly managed to avoid prosecution.
We got scams, we got pump-and-dumps. I don't go more than a couple of days without someone reaching out and telling me that they got cheated in one way or another.
The crypto market has destroyed more than $2 trillion worth of wealth in the last 12 months. And a lot of that is due to so-called investments being promoted in ways that would never be allowed if they were regulated securities like stocks or bonds. If these instances of fraudulent activity were included in the total, it would add up to be hundreds of dollars per American. Of course, this financial burden is not shared equally. There are people that have lost their entire life savings to frauds like this, and then there are people who thought that after reading stories about the 15th shitcoin rug pull in a row, that maybe a 401k was a better vehicle to securing a financial future. But unfortunately for this person, and all of you who are watching and feeling smug at the expense of people who got suckered into these schemes, we are all paying the price for fraud. The $5.8 billion reported by the FTC only includes verifiable and enforceable cases of fraud that have actually been reported to them. More has been lost to fraudulent activity that falls outside their narrow definition, and much more even still just goes unreported because people would rather not say that they got tricked out of their money. But an even larger cost is borne by everybody in the form of additional checks and balances that need to be put in place to avoid fraud in the first place. If you have ever wondered why it costs so much to send money overseas or why loan applications take weeks to process, it's because of fraud. A large share of the premiums you pay on your insurance and the hoops you need to jump through to get a rental are because of fraud. Financial institutions are required by law to have systems in place to protect their customers from fraud, and that means that they need to treat every interaction they have with you as if you are either a fraudster or a potential victim of fraud. The Government Accountability Office found that American banks were spending between 0.4% and 2.4% of their total operating expenses on anti-money laundering and bank secrecy compliance every year. Every new account costs a bank an average of $15, which might not sound like much, but it adds up quickly with some institutions managing over 100 million accounts. Fees are not the only problem expense either. Banks have been fined hundreds of millions of dollars for facilitating fraud, and in order to try to avoid fines and the reputational damage they do, most institutions hire large teams to constantly monitor all of their customers for anything suspicious. Due diligence like this is designated to stamp out fraud, amongst other criminal activities, but the costs are eventually passed along to consumers. There is little doubt that high-profile cases like FTX will be used by regulators as an example of why this kind of oversight is necessary in an industry that has prided itself for being totally decentralized and therefore impossible to regulate. Every check and balance regulated institutions are forced to do was the result of some type of fraud that regulators want to avoid in the future. I don't make it a habit to defend multinational banks, but one of the biggest complaints people have with them is being charged to simply have an account with them even if it has no money in it. In truth, most banks would probably love to be able to offer free accounts to everybody, but the compliance cost of those accounts means that it's not commercially viable unless they know they can cross-sell a revenue-generating product or charge you an account-keeping fee. Fraud is responsible for a lot more than just some pesky fees, though. As a part of a study, banks reported to the GAO that they had restricted access to high-risk products in an effort to reduce their exposure to fraudulent activities and the regulatory expenses that came with it. These so-called high-risk financial products were things like equipment loans, business lending facilities, and securitized investment lending. That might not sound that important, but these were typically the sources of funding that people would turn to when they wanted to start a new business. If people can't raise the money they need to get a business going, then they will personally miss out on the opportunity to build a vehicle for wealth generation, but also miss out on providing opportunities to potential suppliers, customers, and employees. The costs that we all indirectly bear become particularly disappointing when you learn about how effective these measures are. Know your customer, anti-money laundering, and bank privacy regulations were instrumental in the prosecution of less than 100 individuals in 2020, and of those, many were not caught by these checks, but rather charged for wire fraud or money laundering as an addition that prosecutors could add to crimes that these people were already being charged for. The cost of lending limitations due to fraud is impossible to put an exact number on, but it would be a lot, and it creates a regulatory environment where the only people worth doing business with are those that already have lots of money. You might think that blaming the landscape of modern banking exclusively on fraud is a bit of a stretch, so let's look at a more direct way that fraud has cost you your financial future: student debt. It's no secret that student debt has ballooned in the past 2 decades, but did you know that fraud played an important role in making sure that people start their careers with larger debt than their parents had to take on to buy a house? Before 1979, student loans could be discharged with bankruptcy like any other personal debt, but people were taking advantage of this by getting advanced degrees and then filing for bankruptcy as soon as they left college. There are downsides to bankruptcy, but for many young students, it was a small burden compared to the debt that they would have otherwise had to pay. To close this loophole, Congress passed Section 523 of the U.S. Bankruptcy Code, which made it extremely difficult to discharge student loans, both public and private, for any reason bar extreme hardship like a debilitating or terminal illness. The law has been updated 5 times since then, most recently in the year 2005, where amendments were made to expand the classifications of student debt, and even extend it to students who fall outside of the conditions of their scholarships, which can have that grant turned into a debt that they are liable for. This legislation was a boon for the education industry, because they now had the ultimate form of secured debt, so they took on very little risk when they started writing loans to anybody, regardless of their career prospects and ability to repay. The explosion of new student loans drove up the price of tuition, which means now it is next to impossible to get a degree without wealthy parents, a scholarship, or a big loan. What started as a perfectly reasonable way to remove a loophole that a small handful of people were taking advantage of by fraudulently claiming bankruptcy has turned into a multi-trillion-dollar industry, which is costing many. Companies are under a lot of pressure from investors and customers to reduce their environmental footprint. Carbon offsets were an easy solution that for a while kept stakeholders happy. Unfortunately for the companies patting themselves on the back for their ESG efforts, people eventually realized that these offsets achieved nothing. Major investors have lost hundreds of millions of dollars in just the last week, and now a multi-billion-dollar speculative market that you weren't supposed to know about is imploding.
A Dutch court says Shell must reduce its CO2 emissions by 45% by the year 2030.
But environmental groups are really skeptical. They argue that offsetting now can simply be a way for the wealthy to avoid or delay taking the necessary steps to reduce their use of fossil fuels.
We issued $5.75 billion in sustainability bonds, the largest by any company in history.
Anytime you see a company promoting a product as carbon neutral, it got that status by buying a security off an unregulated financial market. If a clothing brand like Gucci emits 1 ton of carbon to produce its hideous pair of flip-flops, they can buy a 1-ton carbon credit to offset their emissions and market their shoes as carbon neutral. There are 2 major non-profit organizations that dominate the market for these credits: Vera, headquartered in DC, and Gold Standard, headquartered in Geneva, Switzerland. These organizations do not remove any carbon themselves. They audit other companies or projects like carbon sequestration, forestry, and agriculture. If you own a company that can prove to Verra or Gold Standard that you have removed a ton of carbon dioxide from the atmosphere or prevented it from being released in the first place, you can get given a verified carbon credit. Verra and Gold Standard both have an application and verification process for companies that want to start receiving verified carbon units. Verra charges an application fee and a verification fee, and a fee of 10 cents for every carbon unit awarded, with a discount applied to companies that are issued with over 1 million carbon units in a calendar year. If you owned a company that was reducing carbon emissions in a way that you could verify with these organizations, it's worth paying these fees because you can then take your carbon unit and sell it at a markup to a company like Gucci so they can sell their flip-flops as carbon neutral. This entire process is separate from the legally required cap and trade programs like ones enforced here in California and in the European Union. But if this is entirely voluntary, why the fuck are companies paying millions of dollars every year to buy these credits? Well, there are 3 reasons, and none of them are because these companies really care about the environment, although that's what they would like you to think. It's not even for marketing. A survey conducted by the Harvard Business Review found that 65% of respondents said that they would want to buy from purpose-driven brands that advocate sustainability, but only 26% actually did. If you have ever seen a carbon-neutral logo while doing your shopping and acted on it, well done. But most people are not like you. The 3 real reasons companies are spending billions of these voluntary credits are the same reasons that the whole system is now falling apart. The first reason companies are actually doing this is because it lets them take advantage of new investment trends. ESG stands for Environmental, Social, and Governance, and it has been a popular investing practice since 2008, when a lot of companies were criticized for immoral conduct. Investors wanted to put their money into companies with good ethics for 2 reasons. The first reason was because they thought they could generate better returns. Companies in environmentally friendly fields looked like the future, and if the companies that collapsed in the mortgage crisis had better governance, they might have survived in the first place. The second reason was because people wanted to pat themselves on the back for doing a good thing by only supporting companies that were ethical. Unfortunately, it is questionable at best if these well-intentioned investors achieved either of these goals. In the beginning, ESG investing required people to individually pick their stocks and research the company's financial and operational credentials as well as their ESG performance. It was time-consuming, and individual stock picking is very risky. The trend took off when asset managers like BlackRock and Vanguard introduced mutual funds and index funds with their own ESG certifications. This led investors to buy one diversified group of shares out of the box that was already certified ESG compliant, although that really had no official meaning. The role of senior company leadership is to maximize returns for their shareholders. That is their legal and fiduciary duty, and more importantly, how they secure their annual performance bonuses. Every boardroom in America saw this trend, and they knew that if they got their company listed on an ESG index, it would boost their share price because more potential investors would buy their stock. Getting into these ESG indices was surprisingly easy. ESG funds were made using either the inclusion method or the emission method. The inclusion method was much more rigorous. Fund managers would go through companies one by one and only accept businesses doing outstanding work to benefit the environment. The problem with this method is that it wasn't very well diversified. If you bought into such a fund, you would be overexposed to electric cars and renewable energy companies, which are highly speculative. A more popular method was the emission method, which took an existing index like BlackRock's IVV S&P 500 index and kicked out the bad actors like tobacco, gambling, and weapons companies. These funds still wanted diversity in their asset base, so they let these companies back in if they could prove that they were better than other companies in the same industry. And the easiest way that companies found to get past the ESG bouncer was to offer carbon-neutral products. And that's how companies like Royal Dutch Shell, Exxon, and Nestle made it into the ESG funds, but Tesla was excluded from them. You don't have to like Musk, but it's hard to argue that the company that made electric cars mainstream is a worse ESG candidate than the world's largest oil companies.
Suspicious. Very suspicious.
The performance of ESG funds was initially promising, although that had a lot to do with the investors rushing into the space rather than business fundamentals. In a recent Journal of Finance paper, University of Chicago researchers analyzed the Morningstar sustainability ratings of more than 20,000 mutual funds representing over $8 trillion of investor savings. Although the highest rated funds in terms of sustainability certainly attracted more capital than the lowest rated funds, none of the high sustainability funds outperformed any of the lowest rated funds. The actual power that companies like BlackRock and Vanguard have over the companies they invest in on behalf of their clients is usually overstated, but even they have started pulling back on ESG initiatives. If buying carbon credits to be carbon neutral isn't going to make a company any more attractive to these groups of investors, then they aren't going to waste the money on a voluntary expense that, according to some studies, actually does more harm than good. The companies that make carbon credits, the company that use carbon credits, and the nonprofits that regulate this voluntary market are not the only players in this game. The market for carbon credits became so large that hedge funds started trading carbon credits in unregulated private markets. The price of carbon credits varies depending on how many projects are producing the credits by taking carbon out of the atmosphere and how many companies are buying the credits to make their products carbon neutral. Trading firms like the Trafigura Group moved into this market and attempted to profit by speculating on these price fluctuations. Unfortunately for them, they have now lost a significant amount of money because the value of voluntary carbon credits has fallen from a high of $19 in January of 2022 to $1.77 in September of 2023. A loss of more than 90% in 18 months. And that's because of the second reason this market became so popular to begin with. It slowed down regulation. There are other markets for carbon credits that are not voluntary. The largest of such is the European carbon credit market. Companies in the European Union have a cap on the amount of carbon they are allowed to emit, and once they go over that cap, they need to buy carbon credits for every ton they are over. The price of a metric ton of carbon in the EU is currently around $82, which is 50 times the price of a ton of carbon in the voluntary markets. The price of carbon credits in the European markets has been increasing at the same time as the price of carbon in the voluntary markets has been crashing. The reason that the voluntary markets were so popular to begin with was that companies liked the idea of self-regulating. If they could prove to the public that they could go carbon neutral with voluntary carbon offsets that cost $19 a ton, it is less likely that they would need to buy mandatory carbon credits for $80 a ton. Going carbon neutral by choice was cheaper, and it let companies run PR to investors and customers about their green initiatives. Some of these claims sounded too good to be true, and that's because they were. The third reason this multi-billion-dollar market is collapsing is because the whole scheme never worked in the first place. According to a study led by Cambridge University, on 40 Verra-approved projects, as much as 94% of the carbon credits sold never actually removed any carbon from the atmosphere, but they still let companies claim their high-emissions products were carbon neutral. So how the f*** did they get away with this? The organizations like Verra creating carbon credits are non-profits, but they still need to make money to keep their operations going and further their mission. These organizations do not take donations. They make all of their money from the various fees projects have to pay to register carbon credits, so they have an incentive to allow as many to be created as possible. According to ProPublica, in the company's own filings, Verra generated $40.5 million in revenue in 2021 and had assets worth a total of $50.5 million. They also paid their CEO a total compensation of $370,000. When you hear carbon removal, you probably think of projects like this one, big machines that literally suck carbon dioxide out of the atmosphere. That's what they would like you to think, but most carbon credits had nothing to do with machines like this and were instead created in rainforests. The cheapest and therefore most popular way to produce voluntary carbon credits was to buy tracts of land in the Amazon for preservation. The trees not logged were accepted by Verra as carbon that won't be released into the atmosphere, so they qualified for carbon credits. Preventing deforestation is a great cause, but the Cambridge report revealed that most of the land set aside for preservation was never going to be logged anyway because it was too remote and difficult to get to, which is why it was cheap to begin with. Because this land was useless for any company, it was very cheap, so it became the most popular way to generate carbon credits. Following this report, Verra's CEO that had run the carbon credit certifier for 15 years resigned. In a press statement, the nonprofit said his sudden departure was made for unrelated reasons. The bombshell report has attracted the attention of regulators, which are now cracking down on the carbon neutral branding. Investors and customers trusted these certifications and changed their investing and purchasing habits around them, believing they would do some good. This put less pressure on businesses to pursue real solutions that actually would have a positive impact on net emissions.
And I'm a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, if we're not going to do it correctly, in a way that actually does help mitigate climate change, then it's nothing but a distraction.
The trading firms that were holding on to these carbon credits with the long-term vision that they would become more valuable in the future have had to write them off as completely worthless because companies are no longer interested in buying them. In an interview with Bloomberg, the head of carbon trading at Trafigura, the largest carbon credit trader in the world, said that the complete loss in value in some corners of the voluntary carbon credit market is unlike anything she's witnessed. Now that Vera and Gold Standard have put new restrictions in place to define what counts as an offset, a new registry opened in the Middle East to hand out offset certifications to companies that don't care and just want to put carbon neutral stickers on the stuff they sell. Banking has a fraud problem that's not new, and it costs clients billions of dollars every year. We are also used to this now that it's not even shocking anymore. But there is now a simple solution that can eliminate this problem while actually saving banks money. However, banking executives want you to forget about this solution as quickly as possible or just convince you that it won't work.
Goldman Sachs has agreed to pay nearly $4 billion to settle legal action over Malaysia's 1MDB scandal.
Banking giant HSBC has been fined £64 million, roughly $85 million by British regulators for failings in its anti-money laundering processes.
And Wells Fargo has faced steep fines in the past for fraudulent accounts opened without customers' consent.
Regular viewers of the channel will know that I hate dragging out the answer to a simple question for the sake of watch time. So the solution is to force bankers to work from home where they actually have less oversight from managers than authorities. A recent study by the European Journal of Financial Management found that bankers were 5 times less likely to engage in financial misconduct when working from home. There are 3 reasons why this works so well, and 2 infuriating reasons why executives won't let it happen. The first reason is simply because everything done from home goes on record. In America, banks are not allowed to delete most records for 5 years, and that's not just financial transactions and signed contracts. It also includes internal files like emails, meeting minutes, and instant chat messages between employees. A $1 billion lawsuit was recently settled with major banks that didn't put effective measures in place to stop their employees sending messages via encrypted messaging platforms like WhatsApp that don't leave the required records. There was no way to tell if these bankers were talking about their plans for the weekend or conspiring on an insider trading scheme.
But when it comes to record-keeping matter, we've never seen fines of this size.
Laws vary in other countries, but there's also one record that's impossible to keep track of, and that is in-person conversations. There are 3 types of conversations that happen in banks with alarming frequency that make this a serious problem. The first is a bank manager with performance goals that leans on their staff to push new product like a salesman instead of doing what's in the best interest of the client. If you have been unfortunate enough to walk into a bank branch, you were probably offered a credit card, car loan, new savings account, or a refinance on your mortgage. Bank staff are not supposed to do this, but they do it anyway because their managers put pressure on them in private conversations to hit targets that can't be reached without turning the bank branch into a sales floor. The second type of conversation that causes problems for banks is insider trading. Bank staff and staff in other financial service companies are exposed to a lot of material non-public information even at a junior level. It's unavoidable that businesses need to disclose certain information to banks as part of their regular operations, and it's easy for bankers to tell if a company is going to outperform or underperform market expectations on their next quarterly report.
And this is important because in parts of the world where such rules are not enforced, the public lose faith in markets, which both makes it hard for companies to raise money, as no one wants to invest without inside information, but it also prevents the public from earning a good return on their savings by investing, which is bad for the economy.
Insider trading happens all the time because the rewards outweigh the risks. A junior analyst working in corporate services at a bank can earn between $80,000 and $150,000 per year. But if they can trade on a regular stream of inside information, it's possible to make 50% annual returns or more. Just investing $1,000 a year into a portfolio making 50% returns would make you a millionaire in 12 years, far quicker than it would take an analyst to save that money even with their above average salary. They can't act on this information themselves because it is too easy to track. But passing around information through quiet chats after work on a quid pro quo basis is impossible for the authorities to track and even harder to prosecute. When there is less opportunity to mingle outside of official channels, the relationship required to insider trade takes longer to form and carries far greater risk, so people just don't do it. The third type of conversation is just common lies to cover up negligence. Banking is filled with procedures and policies that are practically impossible to get right all the time. People will forget to make disclosures or inform counterparties of something they should have. This is fine, but when business is being done face-to-face, it can be easy for bank staff to lie about missing something when they know there is no record of those meetings. When everything is done through recorded channels, it's harder for staff to get away with a little lie like this, and proper remedies can usually be taken to fix it with no harm done to the bank or the counterparty. Now, I can already hear you saying why you think bank executives are so keen to get back into the office. They want to be able to keep these practices going, but that's not really true. The top executives making decisions about work-from-home policies are far removed from these regular client-facing interactions. According to a study conducted by the Oxford Business Law Blog and Citadel Securities, the group of people most commonly conducting insider trading were junior executives. Senior bank executives and the C-suite are under so much scrutiny by internal compliance and external authorities that it's very hard for them to personally profit from insider trading. Above a certain level, banking executives have to plan their trades in advance with the SEC and make public disclosures about their purchases and sales. They can pass along information to friends and family, but they too are closely monitored. For it to be worth it to people already earning millions of dollars in annual compensation, they would need unaffiliated people to trade millions of dollars, and that too is extremely easy to track. The first real reason why banking executives won't allow a work-from-home model is because the systems in place to monitor staff for misconduct are a little bit too good.
And we use this a lot if we think that somebody on staff maybe is gathering up contacts from the company to maybe start their own competing business. That's where we can make that connection, and we can let the business owner know this is coming down the pipe.
The reason that these quiet conversations happen so often in banks is because it practically never gets prosecuted. There is a not particularly funny joke in finance circles that you should never hire someone who is convicted of insider trading. But it's not because they, broke the law. It's because you don't want anybody stupid enough to actually get convicted of insider trading on your team. When staff are working in an office, misconduct is easy to sweep under the rug, and most of it goes completely unnoticed. When every interaction is monitored, everything has to go through official processes. So what could have been a quiet conversation with a manager turns into something that involves a binder and a compliance department. Banks are struggling with this, because higher rates of reported misconduct take staff away from printing business, and it looks bad to stakeholders even though the real rates of misconduct are actually down. Now, so far, this has all been about banking, but misconduct happens everywhere, and there are reasons why nobody at the top wants to fix it. The second reason that misconduct fell so significantly when people were sent to work from home is that people are removed from bad influences. In every office, there is always going to be some people that are willing to bend the rules to get ahead or stay out of trouble, but most people do try to do the right thing. The researchers from the study found that the bad behavior of those people was more visible to other staff when they were forced into an office together. Having exposure to unscrupulous peers made regular staff normalize the behavior and become more likely to engage in it themselves. This happens in all companies, and the people in charge of your money are no different, but it's still better than this happening to people in charge of your safety.
We have police officers who are allegedly, during a 10-year period, have been sued for excessive force, for wrongful arrest, for illegal search and seizure over and over again.
A similar study published by the Journal of Nature and Human Behaviors found that a pattern of misconduct from one police officer in a department can quickly spread and normalize misconduct between all officers. Law enforcement should be held to an even higher standard than bankers, but the study found that even when departments were shuffled around in an attempt to stem the transgressions, it often had the opposite effect, with the negligent officers just spreading their bad behavior around their new team in what the researchers called a behavioral contagion. A solution that was found to work, though, was suspending offending officers even for minor breaches, or getting them to do administrative work separate from their colleagues. Whatever your opinion on giving officers that engage in misconduct a paid holiday is, the study still shows how effective giving people space away from their peers is at cutting down on bad behavior. And that's unfortunately the second reason that bankers especially want staff back in the office so much. Bending the rules is a selling point. When questioned about his decision to require all staff to return to the office, Jamie Dimon, the CEO of JP Morgan, said that the bank had lost business to competitors that met with clients in person while JP Morgan staff were still working remote.
To build and develop a deeper relationship on the Zoom world.
There aren't many reasons why an in-person presentation of banking services would be more compelling than a remote presentation, apart from an understanding to bend some rules or overlook some details to get the business done. For big commercial deals like the ones Dimon is talking about, no two agreements will be identical. But speaking from personal experience in the investment banking field, flexibility around internal policies is always a strong selling point for clients. This does not mean that staff meeting with clients in rooms behind closed doors are committing fraud necessarily. More often, they are just able to negotiate more freely and relax internal policies without being anxious that their meeting is being recorded and could get them in trouble. Being in person also lets staff schmooze potential clients with expensive dinners and exclusive parties. It's not supposed to influence the decision of the business executives to choose one service provider or another. But come on, they wouldn't do it if it didn't work. The third reason that companies are ignoring the misconduct benefits of working from home is because they simply have too much invested in their offices. Even the CEO of Zoom recently announced plans to bring all staff back into the office because he was sick of online meetings.
When you have Zoom, the company that arguably benefited more than any other company from the work from home trend itself, saying, you know what, there's probably a benefit to being in person at least a couple days a week. I think that says everything you need to know.
There are so many more advantages to working from home other than just cutting down on misconduct, and some of those reasons are more important to company executives. Financial fraud is at an all-time high. American consumers lost a staggering $5.8 billion to a range of schemes in 2021. This represented a 70% increase over losses in 2020. This is part of a bigger trend, which is seeing more people lose money to scams, schemes, and hacks at a time when all of us should probably know better. Consumers were just one group hit hard by scams. Corporations and even the government have seen a serious increase in losses caused by fraudulent behavior. There are a few reasons behind this trend which are worth exploring and understanding, because they can give us clues about how these scams work, how they can be avoided, and why record-high fraud figures might actually be a good thing. Now, even if you think you would never fall for any of these schemes, they will still affect you. History has been littered with distinct spikes of financial fraud before, and it doesn't end well if you never fall for any of these schemes yourself. 2.8 million people filed fraud reports with the FTC in 2021, which was the highest amount since the agency started tracking this data in 2001. This means that there are more attempts being made than ever before. Fortunately, only 25% of these attempts led to an actual financial loss, but the people that did lose money lost an average of $500. If I asked you to think of the typical fraud victim, what comes to mind? Probably an old grandparent that naively thinks that everything on the internet is real, right? Well, you would be wrong. Younger Americans were actually the most frequent target of consumer financial fraud schemes. The reason that you think of grandma is because you are probably thinking of email scams. And yes, people over the age of 70 are the primary targets for those, but consumer fraud comes in all shapes and sizes. The average victim of a job opportunity scheme was under 30 and lost almost $2,000. These schemes work by promising a job to give the scammer access to any of these three things: money, personal information, or free labor. The most basic job op scheme involves a scammer posing as a job recruiter or a headhunter for a well-known company, offering an amazing sounding job. The only catch is that they require a fee for their service before you can start your work. Real recruiters will never ask for money, and headhunters are paid by the hiring company. It sounds straightforward, but if you are a young worker struggling to find a job and then go through multiple rounds of fake interviews only to be offered with what sounds like an amazing position, you too might be tempted to take the risk and give up a few $100 to pay a hiring fee. Variations of the scam will have workers pay for uniforms, home office setups, or training materials before they can start work at a job that obviously doesn't exist. Another common job opportunity scheme will have hopeful applicants hand over their bank account details, ID, and social security number to an identity thief who will use this information to take out loans without the victim's knowledge. If a random person on the internet asked you for your driver's license, you would normally tell them to fuck off, but it sounds like a perfectly reasonable request from a would-be employer. Another job opportunity scheme involves people doing weeks of work and then never being paid. This is a big problem amongst freelancers who might work on one project at a time and never receive payment for it. This type of scheme is very hard to track, and without proper contracts in place, it can be very hard to prosecute too. The shift to working from home has accelerated these schemes big time. For obvious reasons, these scammers never meet their victims face to face. In 2019, a job interview that didn't involve coming into the office would have been out of the ordinary. Now, of course, the entire employment process taking place over Zoom and email is just business as usual. Add in millions of workers who are shifting jobs or struggling to find employment in a messed up jobs market, and scammers have not been short of opportunity. The costliest scam to hit consumers was investment fraud, with the average victim losing over $3,000. This is any type of scheme that involves falsifying an investment opportunity to gain money from a victim. Fraudulent investment schemes range anywhere from Bernie Madoff's $65 billion Ponzi scheme, which took money from some of the richest people in America, all the way down to penny stock schemes targeting unsophisticated investors who think 2,000% returns are realistic. The biggest addition to this space in the last few years has been cryptocurrency investment schemes. This space is so new that regulation hasn't caught up with how to define stuff like NFTs and cum rockets. People are constantly exposed to stories about people making millions of dollars off being early investors in the right virtual monkeys, and greed gets the best of them. People are capitalizing on this greed by creating multi-million-dollar pump and dump schemes that seem to collapse every other week. The particularly attractive thing about these schemes is that they have inbuilt anonymity, and a built-in way to launder the scammers' ill-gotten gains. The whole space also builds off itself. One thing that scammers do to make their scheme appear legitimate is to buy high-priced NFTs to use as their display. Now, I personally don't understand why someone would think, oh, this guy spent $500,000 on a picture of a monkey, he must be legit. But people do. I guess it's the equivalent of a sleazy salesman driving a Cadillac. The scammers buy these existing NFTs, which drives up their price, which generates more headlines, which brings more potential victims into the world of cryptocurrency. If you think of this space as a gamble, you will probably be fine. But if you prefer regular gambling, then you need to be aware of investment fraud as well. The Professional and Amateur Sports Protection Act of 1992, or PASPA in short, effectively outlawed gambling on sports here in the United States. The law was overturned in 2018, and it opened the floodgates for states to legalize sports betting, which was quickly followed by proprietors offering gambling online. Less than 4 years later, and Americans are now spending $92 billion per year in online sportsbooks. Gambling has its own problems, but this massive market has attracted a new breed of scammer that will sell you tips on who will win certain games, all for a fee of course. To legitimize their schemes, these scammers will often bet on both teams in a game and post the winning ticket to their Instagram after the fact to prove that they are the winner. This type of scheme can be particularly devastating to victims, because not only are they losing money that they paid to the scammer, they will also lose money by gambling on worthless advice. Just remember, if someone has a formula for making money by gambling, they are never going to sell it to you. Consumer fraud is just one area of fraud that is on the rise, and it has grown hand in hand with commercial fraud. This is the type of fraud impacting business and governments. A type of commercial fraud that took off during the pandemic was the illegitimate receipts of government subsidies such as paycheck protection loans. The loose oversight of these loans has led analysts to conclude that as much as 15% or $76 billion worth of these loans were completely fraudulent and are unlikely to be repaid. Fraudulent companies are also becoming more popular. The big names like Theranos and Nikola have made headlines, but they are just the tip of the iceberg in the pre-IPO investment space. Private equity has also ballooned in size in the last decade. More private equity firms in larger fund sizes means more money to go towards good ideas, but also more money to go towards ideas that don't work, are unmarketable, or simply fraudulent. Even normal businesses, separated from investment hype, can fall victim to more run-of-the-mill scams. A classic scheme involves a scammer sending messages to company emails. The email will forward them a page that looks like a company platform that prompts them to enter their login credentials. The fake page will record these details and forward them to a scammer who can now monitor their email traffic. The scammer will then look for the people that are responsible for payroll and expenses. Once they have figured out a target, they will copy one of the invoices that a company had previously paid to a legitimate supplier, but just change the bank details to their own. Most company accountants are not going to cross-reference the bank details on old invoices. Even if they do, the scammer can just follow up the email by saying that they have updated their details. This doesn't just affect small companies with poor payment processes either. A Lithuanian man was recently charged for stealing over $100 million from Facebook and Google with a variation of this scheme. Okay, so financial fraud is at an all-time high. What does this mean? Apart from be extra careful and don't trust anybody ever? Well, believe it or not, this might actually be a good thing. The FTC itself said that most financial fraud goes totally unreported. Victims know there is little to no chance of ever getting their money back, and all we'll get from reporting the crime is a lot of questions and feeling of humiliation. Even companies do their best to cover up the most minor breaches, because they don't want to be known as an easy target for the next scammer. The fact that financial fraud reports are at an all-time high means that people are reporting it. Public awareness is a good thing, and more reports means that there are more chances for the authorities to catch these people. We are also starting to see people face consequences for fraudulent activity in fields that were previously difficult for institutions like the FTC or SEC to follow. Fraud is a part of the free market, and anytime there's a new trend making people lots of money, there will be schemers on the sidelines ready to take advantage of people looking to make a quick buck. Now, if you enjoy learning about how fraudsters play their trade, go and watch my video on how Jordan Belfort's Stratton Oakmont scheme actually worked. It's kind of like the deleted scenes from the movie that Scorsese cut because it would only appeal to business and finance geeks. I'm sure you will love it.